So you're probably interested in getting into real estate to make money, but how do you make money when you need money to get into real estate? So today I wanted to talk through 5 different ways to fund a flip, because many times people start in real estate with flips to build capital, and then potentially that goes into buying long-term rentals down the road. But flipping is a great way to build capital. You just need the money to actually buy and renovate the flip. So today I want to share with you 5 different ways, and these are not all the ways, but it's 5 useful, helpful ways that you can learn how to raise money or get funds for doing your first or next flip. So let's start with number 1. The first option for funding a flip is a bank loan. Yes, banks will actually fund flips. Now, you're probably not going to find a bank loan from Chase or one of the big banks like that to fund a flip, but a lot of local and regional banks and credit unions will fund flips. You just have to go to them and let them know what your plan is. Now, the pros to using a bank loan for flips is that this is a pretty traditional, standard way to fund real estate, and they're going to be able to walk you through the whole process and all the paperwork and everything that you need to do to get that money for your flip. So all in all, a bank loan is a fairly simple option. The cons to this option are a couple things. First of all, you are going to probably have to qualify through more traditional means, meaning your income and DTI and things like that, to be able to get a bank loan for a flip. Now, sometimes you can get bank loans to give you money for a flip as a commercial loan, as something that's strictly based on the project itself, but you're going to need some sort of body of work to prove that you know how to flip houses. So if this is one of your first flips or your very first flip, you might not get a bank loan without also qualifying personally for the loan. So if you're not in a position financially where you're going to qualify for a loan, bank loans might not be the option for you. The other con to a bank loan is that they can take some time. Just like when you buy a home traditionally, where you might have a 30, 45, 60-day period between going under contract and closing, and a lot of that is because of the financing paperwork involved. A bank loan for a flip could take a little while compared to some of the other options we're going to talk about. So it's not going to be the fastest option for funding a flip, but it is a simple option that you can use. Go to a local or regional bank or credit union and start making relationships and understanding what they need from you and what their terms are for funding flips. Option number 2, hard money loans. So you've probably heard of hard money loans and hard money lenders. This is a great option because they're more likely to fund a property based on the project itself and not on you as the borrower. They may still need to see your credit score or some amount of information about you as the borrower, but it's not going to be as heavily based on you so much as it will be based on the property itself and the project itself. Now, this option, hard money lending, can be really fast. These institutional groups, these larger groups that do this, Longhorn Investments is one of them that I can think of off the top of my head. They do a lot of these and they've got the process down and they can move pretty quickly for you on a flip. Also, depending on how good the deal is, you might not need any money down with a hard money loan. With a traditional bank loan, you may still need to put some money down. With a hard money loan, if you're getting a really good deal on that property and you can prove that your purchase plus renovation is all within 75% of that after repair value, the ARV, then hard money lenders might give you 100% of the money that you need to purchase and renovate that flip. Not all of them, but many of them, I think that's an option. So it is a great option for speed and for getting all the money that you need. Now, the downsides to flipping with hard money is that the terms are pretty rough. Very high interest rates. I've heard everything from 12 to 15 or 16% interest on the money that you're borrowing. And on top of that, they're often charging points. A point stands for a percentage point of the amount that you're borrowing. So if you are borrowing $150,000, you're buying a house for $100,000 and you need $50,000 in renovations, then every point they charge, that's another $1,500 they're going to charge you. So they might say, okay, we're going to lend you $150,000 for 6 months at 14% interest and 3 points up front, or 3 points when you close the deal. So that means in addition to the 14% interest that you're paying them, annualized interest, you also have to pay them another $4,500 additional on top of 14% on the money you're buying. So it's pretty high fee. But like I said, they're pretty fast and they're a little more flexible in how they qualify you for a loan, and you might be able to 100% fund your flip with no money out of pocket with a hard money lender. Option number 3 is a private money loan. Now, this is really similar to hard money loans, except it's probably not a big institution. It might be an individual person who does private money lending, or it might just be family, friends, colleagues, somebody in your circle who has enough money set aside that they're willing to lend to you for a project. So the great things about private money are that it's really flexible. You can kind of work with the private money lender, especially if it's family, friend, colleague, to figure out the terms of payments, how much the interest will be, just how all of it's going to work. You can get a little more creative with the funding when it's a private money lender. You also might have a slightly lower interest rate than if you were to fund this with a hard money lender. Now, if they're an established private money lender who do this as a single person business entrepreneurship situation, the rate might not be that much less than hard money, but maybe you'd be quoted 15% by a hard money lender and 12% by a private money lender. But you could also potentially do this with family for 8 to 10%. So private money lending could potentially save you on your interest rate and should definitely offer more flexibility than a bank loan or hard money lender. Now, the con to private money lending is it can take a little longer to find a good private money lender. They're not necessarily advertising that they have money to loan. They're not going to have a website necessarily. They're not a big institution with a building on the corner. You can find banks and you can Google hard money lenders pretty easily, but finding a private money lender requires networking. It requires a lot of talking about what you do and building relationships over time before you end up finding a really good private money lender for your project. So it's definitely something to start thinking about now and start looking for and networking with the people who could potentially help you down the road. Funding option number 4 is a JV partnership. JV stands for joint venture. I don't want to get into the documentation side of this or how you legally set this up. You should definitely consult with an attorney if you want to do a JV partnership, but I'll just give you a couple pros and cons of partnering with someone. Basically, a JV partnership would be you bringing someone in who has funds for a project, but maybe they don't have the time or the knowledge to do a flip, but they're interested in flipping. And maybe you've studied up and you're finding properties and you have opportunities and you have the time to manage the flip. So between the two of you, you can make a flip happen. The great thing about a JV partnership is that you guys can work together as partners, figure out whatever structure you want. Just like a private money lender, it can be really flexible and you can be creative about how you structure this. Because you have a JV partner, you're probably not paying interest to that partner. Instead of them giving you debt that you have to pay off, they have equity in the property and in the project. Now, the great thing about this, again, is the flexibility. The downside is you're going to share both the upsides and the downsides with somebody. So if you end up making a lot more on your flip than you expected because you worked hard and you were grinding all the way through to make it happen, they're going to get half or whatever percentage you agree to of whatever that upside is, even if all they ever did was give you the money. And on the downside, if it doesn't go so well, you have to kind of be answerable to them about that. And they share in that downside, they share in that risk because they're a partner, not a lender. And hopefully they understand that, but it's the kind of thing that you really have to speak with a partner about and set expectations up front. Make sure everyone knows the risks involved, because whether it goes really, really well or really, really poorly, you guys are going to have to agree to and honor that agreement that you set up front about how you're going to divide either the proceeds or the losses if you end up with a loss. And that does happen, unfortunately. So make sure you have a really strong agreement and that you talk through all the potential situations with a JV partner before you get into it. But again, it's a really flexible way to get into flipping. You don't have to pay someone interest. You're just going to share in the ups or the downs of the result of that project. Option number 5 for funding a flip would be to use a line of credit. So a line of credit could be something that you get on your own home. If you have a home and you have a lot of equity in it, you could go to the bank and ask for a line of credit on that equity. Or if you have rental properties, after so many years, you've built up some equity, you've been paying down the debt, there's been appreciation, and a bank could give you a line of credit on the equity in your rental properties as well. And the way a line of credit works is almost like a credit card, a much lower interest rate credit card. It's revolving credit. So what you do is you take money off that line of credit anytime you want to use it for a project, and you basically use it like cash. So you can go into properties as a cash buyer because this bank has these funds set aside for you to use when you're ready. That said, you will have to pay monthly interest payments to the bank when you have money pulled from that line of credit. But once you finish your project and you pay it off, you just pay down that line of credit. It's still there. You still want to maintain the line of credit. It's a revolving line of credit, hopefully. But now you've paid them off. You don't owe them anything else. There's no interest payments or monthly fees when you don't have money pulled from that, and then it's just sitting there waiting for your next project. So line of credit is great because you're almost like the bank yourself. Yes, you're using a bank and you do have to pay them interest on what you borrowed from them, but it's based on the equity you have in other assets that you own. Now again, the downside to a line of credit is just like finding a really good private money lender, this option can take some time. If you don't already have a home that has a lot of equity in it, or have rental properties that have built up equity, or some other asset that you could take a line of credit on, you're gonna have to wait until you have an asset that has a loan paid down far enough to have that extra equity. And very similar to traditional loans, a bank is generally not gonna give you a line of credit that takes your total amount of debt up beyond 75 or 80% of the value of the property. So for instance, if you have rental properties worth $400,000, but your mortgages on them are paid down to only $200,000, you might be able to get a $100,000 line of credit. $200,000 in mortgages plus $100,000 on a line of credit is $300,000, and that's 75% of the $400,000 value in your rental property portfolio. So you can't go all the way up to that $400,000. They are going to put a limit on it, but when you have paid things down, now you have another option, and this is actually how I'm funding my current flip, the strip and flip, which if you haven't already subscribed and watched some of those videos about the strip and flip, I'm starting to put a little information out there about how I found that project and what the numbers are, and hoping to bring you guys along on the journey of flipping this property that's 7 minutes away from my own house here in St. Louis, Missouri. So there we go, 5 options for funding a flip. There are more options that exist out there, but I would say these are probably the most common ways to do it, the easiest ways to get into up front. And I hope that you can find 1, 2, or 3 of these options to use. One of the best ways to do well in real estate is to do your research and have a lot of options at your disposal when a project comes your way, so you know you can find a way to fund it no matter what. If you have any questions about any of these ways that we just talked about funding a flip, please drop them in the comments below. We would love to hear what your questions are, and we'll answer you the best we can. Maybe we'll make follow-on videos to clarify some of the details on these options. But either way, we hope you're getting out there, finding some cool projects, and having fun.